From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, tariff tensions ramp up. President Trump targets Canada, Brazil, and others as he threatens to increase the baseline tariff rate. As anxieties in the bond market subside, thanks to solid demand for treasuries this week. And investors look ahead to a big week with U.S. inflation prints and big bank earnings front and center. But we begin with the big issue, moving past peak uncertainty.
There's a sense that we sort of passed peak uncertainty.
Ultimately, it's kind of an environment where you're treading water.
The underlying fundamentals for the economy are pretty good.
The economic data is held in quite well.
It's all about the direction of travel, of uncertainty.
The direction of inflation is going to dictate kind of what happens with yields.
The bond vigilantes are not the only force in the bond market.
We have a lot of things at play that are, for us, pointing towards higher yields.
The market is pricing in a friendly sort of mix of growth, inflation, and policy.
We're going to start to see probably some slowing growth in the third and fourth quarters.
You'd expect the bond market to kind of reflect that and yields to go lower, and that's our call.
The Fed controls the short end of the curve, and I think some of the administration understands that, but they have to be careful of the long end.
We are expecting slower growth in the third and fourth quarters and a rate cut by the Fed in September.
We're not expecting the first rate cut until the fourth quarter. I think we're talking mid-2026. The economy is weakening, and that's ultimately the signal that the Fed is going to be looking at.
There's really no impetus for the Fed to be any more aggressive here.
The bending but not breaking of the economy that we expect is going to lead the Fed to cut rates.
Now, I want to take a look here at the MOVE index because Treasury volatility has been creeping down to a 3-year low. It has been a very volatile couple of years here, and as of late, you have seen a range-bound Treasury. You have seen the 10-year around 4.4%. The good news is you're not at 4.8, but the bad news is still that you're at 4.4. If we flip up the board here, you are seeing actually, and this has been a surprising chart for many people here, the pace of U.S. bankruptcies, according to S&P Global, has been rising, and through June is the highest since you've seen since 2010. And of course, with higher interest rates, you are starting to see a little bit of that funding pressure. I don't want to draw too much alarm here because the rates of defaults are still relatively low, but you are still seeing firms being pressured by the cost of interest. When you look at treasuries, earlier this week, my colleague Haslinda Amin caught up with the CEO of Warburg Pincus and discussed the direction of yields.
Look, this is the first time in 40 years you're seeing a structural step up in rates. I think, as I said today, for a number of factors, I think you'd probably lean towards a 10-year that's probably more in a 4 to 6% range than a 2 to 4% range. And by the way, that's an environment on a long-term basis, that's not, crazy high. As investors, we can make money in that type of an environment.
And joining us now, Mike Contopoulos, Deputy CIO at Richard Bernstein Advisors, and Sonal Desai, CIO of Franklin Templeton Fixed Income. Sonal, you look at where we are right now. How much do you feel bothered by that 4.4% 10-year? Are you saying that this is a level that the market has absorbed and it's just fine, or would you like to see it come down much more meaningfully?
I don't expect it to come down. I actually think, Sonali, that it's more likely to go up than to come down. And there's a reason for this. I've been on the record for a fairly long period of time saying that I think that the neutral Fed funds rate is probably around the 4% mark. Now, if we're not falling into a recession, if you have normal upward sloping yield curves, you would expect treasuries to be actually closer to 475.5. And more than where the markets can absorb it, I think the more interesting thing is can the economy. And I think, yes, pre-global financial crisis, we went through many, many years of having rates at those levels, and the economy just handled it fine.
So, Michael, how do you feel about this as well? Would you take that trade, the idea that rates on the longer end of the curve are going higher? And if you think they are, then would you actually go much shorter?
Yeah, I think it depends on time horizon. On a similar vein, we've very much been in sort of the secular, bull market in treasuries is dead. For a lot of different reasons. We think over the next 3, 5, 7, 10 years, you probably are looking at higher highs and higher lows on interest rates. And obviously that means the 10-year, at 4.3, 4.4, 4.5%. may be on the lower end of what we see over the next decade. With that said, I mean, obviously there's cyclicality to markets, and if the economy does go through a reasonable growth slowdown, which it appears that is entirely possible over the next 6 to 9 months, I would expect Treasury yields to fall. Now, how much? I mean, we're not going to 0.5%. We're never going to see that again. We're probably not going to 2%. Maybe during the next recession, it's 3 or 3.5%, which would likely be an overshoot. But I could see the 10-year getting there. But until you have a real catalyst, either a catalyst for economic growth higher or a catalyst towards recession, I think you're going to live in a range of maybe 4.25 and 4.75, and that's kind of where we are today, and it's pretty unexciting, and probably means you're supposed to be somewhat neutral in terms of duration at the moment.
Mike, get excited. It's a Friday. Sonal, the interesting thing about the comment that Mike just made about that secular bull market being over, it's the second time I've heard that today. What are the ramifications of investors feeling like the Treasury market is not going to be that source of fixed income that would provide that stability in a portfolio?
Oh, well, I would just say that it would be important to recognize perhaps the biggest implication is that we as investors need to start actually pricing risk more seriously than we've needed to, because that secular bull market was largely driven by an enormous amount of liquidity, which was awash, not just because of Fed actions, but global central bank actions. And frankly, we're still pretty much awash with that. It hasn't been soaked up yet. And the biggest implication, Sonali, really to me, is that all of us as investors need to start doing that job of actually pricing risk more appropriately. I don't think it's a terrible environment for fixed income, because it has been, there's probably an entire generation of traders who have never seen true income coming from fixed income, and now suddenly we're in that environment.
Right, yields can be a double-edged sword of sorts.
Yeah.
So you saw the auctions this week, the 30-year auction in particular that a lot of people were kind of anxious about, had done quite well, and yields have generally come down since their heights. What does this mean in terms of how investors feel about the fiscal situation in the United States? Is there a sense that it's not that big of a deal, given all the hand-wringing we've seen? Do investors have a little more comfort that tariff revenue, Mike, will take up some of the pain that we'd be seeing in the deficit, or is it something else that would cause that kind of calm?
Yeah, I don't necessarily think it has anything to do with tariff revenue. It is an interesting, question, though. I mean, you saw indirects with the last auction and now directs with this auction really have strong demand. I think this is the largest on record for directs for the 30-year. So, typically, there's a couple reasons why that may happen. But I think probably the most obvious one is that as you get closer to a 5% yield, that is yield that you haven't had in quite some time, and it becomes attractive. And I think it's as simple as that. I think, there's probably a lot of risk on books out there that, you need to sort of have a counter to, you need to have a hedge to, and whether that be in, overpriced stocks or illiquid private credit or private equity, et cetera, a 5% yield on, the long end of the Treasury curve starts to look attractive, and from a safety perspective as well, and gives you the liquidity that you may need. And so I think that has more to do with it than, lack of fear around fiscal deficits. And I don't think the story is done there either. We've gone up in yields quite a bit since September, when the 10-year got to 369, 365, whatever it was. And I think, it's a place right now, it's at a place right now, yields are, where there's just some value being had, I think.
So, yeah, go ahead, Sonali.
So actually, I would just add to what Mike just said along the following lines. On the fiscal, I think I would completely agree that it isn't really fiscally driven. But having said that, there is an element to which the description of this fiscal package perhaps there was a little bit of hyperbole there. The market has had an extremely long time understanding that the alternative was going to be a $4.5 trillion tax increase, and there was no state of the world, a Republican administration and Congress or a Democrat administration and Congress, where that entire $4.5 trillion would have gone through. So in a sense, what we got out of the package was not incredibly different from what we always expected, which is not a good fiscal scenario, but we started living with the idea that the US is going to have 6.5% budget deficits for the foreseeable future, which is very bad, but it's not different from what we had anticipated. And one other item, if I could, and that is the dollar is actually substantially weaker than it has been in a while, which certainly makes US assets begin to look a little bit more attractive again. There's a big difference between the dollar being at 165 yen to a dollar and the dollar being at something like 145. So I think that also has some impact.
So many cross currents. Now, there's one more here. I want to bring up some commentary from earlier this week. Former New York Fed President Bill Dudley had written monetary policy may not be exerting any restraint at all. The cost of waiting is low as long as the risk to the Fed's inflation and employment mandates are judged as broadly in balance. Now, with the new set of tariff measures that the president has introduced, Mike, do you think that inflation becomes a bigger risk as we head into the end of the year while the president tries to get the Federal Reserve Chair to lower interest rates?
Absolutely. I mean, listen, the first thing I'll say is that, and I know this can be somewhat controversial, but the Fed is pretty apolitical. They just want to do what's right around inflation and employment. And I don't think they're going to be pressured by any administration, which is the right thing to do. And I do think inflation could be cause for concern as you look out towards the second half of this year. I think we saw in the data there was a huge amount of front loading of inventory in Q1. That was to get ahead of higher input costs, and we've seen the input cost data go up quite a bit since then. And so whether it's manufacturers or whatever, whoever's selling anything. I mean, I have 2 coffee shops and we sell coffee, obviously. And, costs are going up and you got to either take that on your margins or pass it through to consumers. And the reality is you're probably going to get a little bit of both, and that's going to hurt both corporate margins. It's also going to hurt inflation. And so I think the Fed is doing the right thing by being data dependent and waiting. And I do think that you likely are going to see inflationary pressures later in the fall.
Oh, I saw a note of skepticism from Sonal's eyes, but I do have to leave it there. We are out of time. Would love, as you know, I love a good debate on this show. Mike Contopoulos of Richard Bernstein Advisors and Sonal Desai of Franklin Templeton Fixed Income. Of course, as you all know, this story is so not over. But up next, we're going to talk about the auction block. This week's bond sales featured Nissan raising over $4 billion with a record high coupon. We're going to give you the details up next. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the auction block, where we focus on the highlights from this week's global bond sales. Starting with my favorite place to look, Treasuries. We had a 3, 10, and 30-year auction. Bloomberg Intelligence points out that the 30-year sale saw direct bidders take down their highest share on record, capping off a week of sales that showed ample appetite for U.S. debt. And over in high grade, weekly U.S. volume was just below $30 billion, blowing through projections by dealers. The big highlight is NTT's massive $11.25 billion sale, which coincided with the deal in euros. The two sales combined to receive orders of more than $100 billion. And in high yield, Nissan was the featured sale. It raised $4.5 billion from a deal in dollars and euros. Big trend this year. Its offering included a record high coupon, with one component carrying a yield of 8.125%, topping Nissan's previous record yield for a 10-year dollar bond issued in 1986. And speaking of credit, earlier this week, BlackRock's Amanda Lynham spoke about the current state of credit risk.
If you're buying corporate credit, buy it for the income, the carry, the yield, not for the potential total return boost from tighter spreads. And I think really the point we're just trying to make is if you're waiting for a sustained sell-off in credit spreads, we view the bar for that as pretty high.
And joining us now, the perfect people to talk about credit risk, Danielle, Poli, Assistant Portfolio Manager for Global Credit Strategy at Oaktree Capital Management, and Viktor, Hjort, Global Head of Credit Strategy and Desk Analyst at BNP Paribas. Danielle, you look at spreads, right? I mean, you look at the amount of complacency that's been in credit markets, and I've got to ask, is there anywhere that worries you?
I think now is credit's prime time. I do. In this type of an environment where you have market volatility and uncertainty, credit can shine. You're in a slower growth environment that likely is going to stop short of a recession. That's where credit's reliability and durability of returns kick in, the contractual nature. And I think that's why we're seeing so much demand for credit right now. Spreads are tight, as you point out, but they reflect a normal range for us in the market. And I think that if you're focused on yield, you are going to get a very nice return. And so we're actively deploying capital in credit right now, feeling comfortable that there isn't too much out there that's lurking that is unknown. There is that smaller cohort of the high yield market, which is stressed and distressed and provides a nice opportunity for those doing capital solutions. But overall, this is a generally healthy market that's providing ample returns for investors.
Viktor, what does this look like when it comes to what your clients want in terms of future demand? Are you finding that there's a lot of dry powder on the sidelines?
Well, I mean, that's the surprising thing, that there is so much dry powder. I would have thought, after all the supply that you point to earlier, and after credit spreads having rallied to ultimately fairly tight levels and with stocks at all-time highs, I would have thought that there would be plenty of signs that investors had maybe exhausted their demand potential. I don't see that at all. If I look at ways of tracking, portfolio risk, whether you look at how much cash investors have, dealer inventories, the kind of beta that funds are running, it's no more than average. That actually is really surprising. What also surprises me is how bearish or how cautious, if you like, consensus seems to be on the outlook for the U.S. economy. There is a very, very strong stagflationary bias to expectations going into Q3. Q3, basically, the market expects inflation to accelerate to north of 3%. The market expects growth, U.S. growth, to decelerate to less than 1%. And that may happen, but if it does, it's not really going to surprise that much. So light positioning, or at least not very long positioning, fairly cautious expectations, that does seem like a pretty good tailwind for markets going forward.
Danielle, you mentioned that you're looking at buying into credit more and more, but I'd love some more specificity. How much is the conviction behind Oaktree's trades right now? How much is being put to work, and where are the greatest conviction trades?
Well, within the global credit portfolios that I manage, we have broad multi-asset mandates. So we're deploying capital across liquid markets, high yield bonds, leveraged loans, structured credit today, with a growing allocation to Europe, where some of the best relative value opportunities are. We're similarly seeing those attractive opportunities in Europe on the private side of our portfolio as we do pair liquid with private credit. I think having that broad mandate allows you to not stretch for risk and assume some of the tighter spread names, but find some really attractive opportunities. Generally, we're staying pretty short duration at this point, relying on the yield that we're able to source in the market. Defaults have remained relatively low, and we think default risk remains low. We are staying away from some of the riskier credits that might impair our returns in our performing portfolios. More on the opportunistic side of our business, we have ample dry powder. We like to deploy that into a dislocation, and there isn't a meaningful one today. There are signs that the economy is slowing. I think during this period of tariff uncertainty, companies have cut back in their spending, though we've started to see that pick up with some confidence. But there will be opportunities that emerge as a result of the data that flows in and what the Fed decides to do. I mean, there is a case on both sides for rates going lower as well as rates going higher, given some of the potential strength that we may see from the big, beautiful bill that makes its way into the economy.
Victor, what would stop the party? The biggest risk to market right now?
Well, it has to be rate hikes. It's obviously not priced in, and it's not what people expect. It is the big bear risk for the simple reason that corporates today have much higher maturity walls or short-term maturity profiles than they actually have in many, many years, and particularly compared to the last time we had rate hikes, which was back in 2022. So in other words, if we were to experience something similar again, it would feed into corporate credit risk much quicker than it did back in 2022, when issuers could be quite relaxed, almost sort of take time off from issuing in primary markets. This time around, they would be forced to issue even against volatility and even against higher rates, and that could be a concern. And let's also obviously remember that corporates aren't the only ones that need to issue, so do Treasury and governments in general. So there's a lot of supply that could be at risk if we were to have rate hikes.
Danielle, Poli of Oaktree Capital Management and Viktor Hjort of BNP Paribas, we thank you both so very much. Enjoy your weekend. Happy Friday to you. But still ahead, y'all should stick with us. We have the final spread, the week ahead, CPI data, trade talks, and my favorite moment, when Wall Street's biggest banks kick off earnings season. We'll get the read number by number. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the final spread, the week ahead. Coming up Monday, EU trade ministers meet, plus we get economic data from China. And Tuesday, big banks kick off earnings, plus U.S. CPI. Wednesday, more bank earnings and the Fed's Beige Book. Thursday, Netflix earnings, U.S. retail sales, and finance ministers of G20 meet. Friday, housing starts and UMISH sentiment. And for my final thought, I want to just look at stablecoin issuance here, because very interestingly, Apollo points out that you're looking at really what stablecoins look like in the really range of hundreds of billions that could go to trillions as a huge source of treasury demand. We'll keep an eye on it for you, but for now, that does it for us. For Real Yields, same time, same place next week. This